Hi, I'm Travis Idle. I'm the CEO of Accounting Management Solutions, and today we're going to talk about financing for small businesses.
So I have a phenomenal idea for a small business. I don't know where to start. How do I get financing for my small business idea?
Financing comes in a lot of different forms. Let's talk about debt and equity. Equity, a lot of small businesses start up with money from your friends and family. If you want loans or gifts from your friends and family, a lot of people start with their credit cards for financing or savings that they have. If we're still talking about equity, savings that they have that they can put into the company. A lot of times people want to tap their 401ks or their IRAs. I typically advise clients to be very cautious about doing that. There are tax implications of doing those. Then we talk about debt financing. A lot of people start out with their credit cards. That's a very expensive way to finance your company. Some people can put business plans together and approach banks. And if you're big enough, approach venture capitalists for equity financing, debt financing, or some combination of the two.
So you've talked in previous videos about how some small business startup ideas are just more financially intensive and technologically intensive than others. Do you think a new small business owner should swing for the fences with an idea like that, or should they start with some more simple small business idea?
It depends on their risk tolerance. My risk tolerance is pretty high, but probably not high enough to swing for the fences. I think you should start small. I think you should have what people call proof of concept. Do you have a good product, and are people willing to pay for that product, and what price are they willing to pay for it? Or do you have a good service, and what price are they willing to pay for that service? Service-based businesses typically have a lower capital expenditure requirement, or CapEx. Basically, you need a cell phone and a laptop, and then your knowledge that's in between your ears. Some people who want to start off of a manufacturing good that they want to produce, whether that's a new food additive or a new cell phone case or any type of major product, especially tech products, those require a lot of upfront capital. I think there are strategies, in my opinion, to have them toll manufactured or to keep you from buying the equipment to build them up front. Start out that way before then you sort of reverse integrate your business and start manufacturing on your own with your own equipment.
So for someone who's starting a more simple small business, someone wants to start a food truck or something like that as opposed to a manufacturing type of business, what are your words of advice when it comes to getting financing from friends or family members like you alluded to earlier?
I think it's always great to start with friends and family. Those people are probably ones who may believe in your business concept a little faster with less sales or proof of concept before they're willing to invest. Friends and family are a great place to start. I always advise clients to try and bootstrap it first. You don't have to have the latest and greatest and best new food truck with the newest equipment. Start out with a used trailer or a used food truck. Spend a little bit of money for your advertising and your logo layout, and then really spend money on your marketing and your product, your food. In that example, if you're going to start a lawn care based business, you don't have to have the newest equipment for mowing, leaf blowers and weed eaters. Start out with used equipment. Start out small, and then build from there as you build profits in the business and as you grow customers.
If someone is willing to invest in your company, but they want a percentage of your company, what's your words of advice about that?
Equity is the most expensive money out there. It's more expensive than credit card financing, it's more expensive than bank loans, it's more expensive than the home equity loan you're going to take out on your house. These are popular things on Shark Tank and The Profit about giving up a percentage of your company, whether that's 10 or 15 or 20% or even 50 or 51% of your company for a certain amount of money. I think one of the big things you start giving up is control. As you give up 10 or 15 or 20% of your company, you are, in many but not all cases, giving some voting rights or decision making that you have to involve another owner with. If you then go out and borrow money on that company from there forward, those individuals have to both sign on for the debt, and in many cases have to also personally guarantee the debt for banks, and they may or may not be willing to do that in the future, which can stifle your growth.
So in your estimation, figuring out a way to finance it yourself is the best way to do it?
I'm personally a control freak. I want control at all times of my company, especially in the beginning. You really want to be able to make the decisions yourself. It doesn't mean you don't want to take the advice of other people, but you do want to have one person with most of the decisions. I advise taking on partners very seriously. Be very careful when you do that. Do all that you can to finance it yourself, although that means you're taking on all the risk. However, there are instances where another person is bringing complementary skills to your business that you may or may not have. That keeps you from going out and hiring those skills if you don't have the capital to do so. And so therein lies a good time to bring on other team members, give them a piece of the upside, which is the equity, shares in the partnership, and also decision making. But then to 2 or 3 or 4 of you can really have a good team and kind of go from there. And there are many, many success stories out there. Most individuals did not do this on their own.
So if somebody goes and gets a business loan from a bank, would you consider that still financing it themselves, or is that still the bank being an investor in the company?
The bank is not investing in your company because they're not taking an equity position. So the bank is financing your company, and if you're the only one who owns it and you're the only one signing on for the debt, then basically you are the one doing all the you are assuming the risk and getting all the financing. I think I'm a true believer in leverage, smart leverage, using those debt funds wisely to purchase the right either people or the right equipment to further your business and hitting your growth targets faster than if you're waiting and just reinvesting profits. Because even the strongest profit margins won't get you there as quickly as having the debt financing come in.
Are there any words of caution, pitfalls people should avoid when they're looking for financing, whether it be from an angel investor, friend or family? You've talked about partnership, but even getting financing from a bank, what should they be wary of?
When it comes to equity financing, be very wary of how much you're giving up. There are investors who will believe in you and believe in your concept, give you capital in exchange for equity, and really trust that you know what you're doing and be there in the event that you need assistance, but will really probably not be in your way or involved in the day-to-day business. There are other investors who will be watching their capital very often and will have almost daily or weekly questions for you and want daily and weekly updates. And it's not that they're not trusting of you as a business owner, but their capital comes with a lot of reporting responsibilities and a lot of involvement in they want to be involved in the decision making. When it comes to financing, obviously watch out for 2 things. Watch out for the rate. Right now rates are rising. Capital has been very cheap for a very long time, and I still think, relatively speaking, it's cheap, but it's not as cheap as it was. So if you went and borrowed money against your home, you're going to pay 2 or 3% more than you were paying a couple months ago, but still you're paying, my guess is probably between 5 and 6%. Which you should, with success, be able to far exceed that in your growth rate and your profit margins. Also, when it comes to debt, watch out for the term. Short-term loans typically can carry less of a percentage rate, but they also carry a heftier or quicker payback. That can really hamstring your cash flow. Companies can sell themselves out of business. That means that their sales growth requires much more inventory, much more receivables that can eat up their cash that they need to repay debt. So you have to, in all this, depending on the type of debt and the term structure that you get, you have to monitor and really do cash flow projections to make sure that you don't outstrip your cash flow in order to repay the debt.
We've seen in the past that people get handicapped by getting hung up on the business plan aspect. How important do you think a business plan is to securing financing?
That's a great question. In my opinion, business plans are for you to make sure that you have mapped out your idea, how you're going to get customers, how you're going to get them to pay, and then your market and what that's going to look like in terms of your maximum growth. It also gives you a chance to plan your financials and your cash flow. But I do not believe in the myth of spending many hours putting together a business plan that is well written and well presented, and then trying to take that to a bank to get financing. When it comes to banks and financing, they're really looking for the collateral, they're looking for the repayment, and they're looking for cash flow. So if you just have a concept and you have no customers, no receivables, no nothing to repay their loan, they're really going to look to either your day job or your spouse's day job or some other type of repayment to get that loan, not so much from your business concept.
What type of collateral might a bank be looking for?
Banks always prefer real estate as collateral. So either your home, obviously, that's probably the first place they look. If you have other investment properties, rental properties, commercial rental properties, family land, those kinds of things. So they look to real estate first. And with real estate, you get longer terms. You get 15, 20, 25, 30-year terms on the repayment of that money. Shorter term would be equipment. So if you're starting a landscaping business again and you want to go out and buy mowers and they're $5,000 or $10,000 a piece, you're probably going to get 5 to 7 year terms on that money and a decent interest rate. You may have to put some money down. And then finally, banks will look to inventory and receivables, so current assets, to do financing on. Those have very short repayment terms. Let's say within 90 days, they will not refinance receivables over 90 days, and they'll look at inventory, and they'll want to look at non-obsolete or current inventory, and they will. The general rule of thumb is that they will lend 80 cents on the dollar or 80% of receivables under 90 days, and up to about 40% of the value of your inventory. Credit cards obviously are financing, but that's unsecured lending, but the rates are very much higher than that, usually anywhere from 18 to 25 or 28%. Lastly, you could also look to your brokerage account or cash value life insurance policies. Those have lower rates. The advance rate I've seen on portfolios that for brokerage accounts are 75% of the value of the portfolio. Interest rates are fairly low. Cash value life insurance, per your policy, you can look and see what the repayment terms are, what the interest rates are for those types of things. And also keep in mind, you cannot borrow against your IRAs. You can borrow against your 401ks if you're an employee and your plan allows that. Those terms are typically about 5-year paybacks, and the interest rate, if I'm not mistaken, actually goes back to you because it's your money and it goes into your retirement plan. There may be some fees from the third-party administrator to handle the loan, but outside of that, you should be able to borrow typically up to 50% of the value of your 401k. Again, be very careful with doing those things. There are tax implications if you do not repay the loan or if you terminate your employment before the loan is repaid.
Now, if people forget everything else in this whole video, what's the one thing you'd like for them to remember?
Remember that just to use this money wisely, whether it's debt or equity, you're not having to repay your investors, but they're expecting to be paid out with a significant return, anywhere from 20 to 40% at some predetermined time if you can. And that repayment would be their capital plus some appreciation of the value of the company. The debt, the banks or finance companies just want to be repaid their loan plus the interest that we owe them. Just keep in mind that if things go south, likely you're going to have to personally guarantee these loans, and then if the company does not repay, the finance companies will come after you personally to repay.